We are going to start Chapter 8. In Chapter 8, we are going to wrap up with our accounting cycle. And so far with our accounting cycle, we've learned how to collect and verify source documents. We've learned how to analyze transactions. We've learned how to journalize those transactions. We've learned to post the general ledger. We've learned how to prepare a trial balance and prepare a worksheet, and we've put together the financial statements. In Chapter 8, we're going to learn how we journalize and post-close entries, as well as prepare a post-closing trial balance. Preparing post-closing trial entries is something that does need to occur every single month, as it matches our accounting concept matching revenues with expenses. The first thing you have to understand is that we have some accounts that we consider permanent accounts and some accounts that we consider temporary accounts. Permanent accounts are used to accumulate information from one fiscal period to the next. Temporary accounts are accounts used to accumulate information until it's transferred to the owner's capital account. Now, this is some information you really just need to memorize. Our permanent accounts are accounts that are found on our balance sheet. And if you think back to our balance sheet statement, what is included in that? It deals with the accounting equation: assets, liabilities, and owner's equity. These are permanent accounts. Assets move from fiscal period to fiscal period. If I have $10,000 in cash in the bank during the month of October, that money carries over to the month of November. We don't close that account. So all of our assets, liabilities, owner's equity continue month to month. Now, our temporary accounts are accounts that we find on our income statement. So what are those again? Revenue accounts and expense accounts. The reason these are temporary accounts and they do not flow from fiscal period to fiscal period is because of the accounting concept matching revenue with expenses. Therefore, the expenses and the revenue portion do not carry over from month to month. So if you take a look, we will also then be learning about closing entries, journal entries that we use to prepare temporary accounts for a new fiscal period. So basically, we're going to be closing our sales account and our expense accounts and moving that into a different account called income summary as we prepare. On your notes, I did include examples of permanent accounts, which I just mentioned. Again, our permanent accounts are our asset accounts, our liability accounts, and our owner's capital account, or our owner's equity. Again, these are the accounts that you see on the balance sheet. Our examples of temporary accounts are the accounts our revenue and expenses. Oh, I forgot to include the owner's drawing account previously, but that one is also because that represents an account that has an impact on capital. And then you're finally going to learn how to use the income summary account. We have seen this on our worksheet, but through Chapter 7, this had a zero balance. The temporary accounts must be reduced to zero at the end of each fiscal period. The purpose of this is to prepare the amounts for the next fiscal period. If these accounts maintain balances, then they would be added to the next fiscal period, violating the matching expense with revenue accounting concept. For example, let's say that we had sales of $10,000 in the month of October. If that amount was carried over in the account to the month of November, and then we had sales of $15,000 in the month of November, it would show in our general ledger that we had sales of $25,000 during that month, which would not be the case. Therefore, that is why we must bring those accounts to zero, and we're going to learn how to do that. Now, to close a temporary account, an amount equal to its balance is recorded in the account on the side opposite to its balance. So, for example, the normal balance for sales is a credit. If we want that to equal zero, what are we going to have to do? we're going to have to debit it for that amount. So let's say that the sales account had a credit balance of $10,000. In order to make it zero, we're going to journalize a transaction in which we debit sales for $10,000, which that means then we are going to have to credit something. And the account that we are going to credit is the income summary. So the temporary account used to close revenue and expense accounts is income summary. So we would do the same thing then for our expense accounts. Let's say, for example, rent expense had a balance of $5,000. The normal balance for an expense account is debit. Therefore, we would need to credit that account. So we're going to enter a journal entry into our general journal to credit our rent expense for $5,000, but now we've got to debit something, and the account we're going to debit is income summary. When revenue is greater than expenses, the income summary account has a credit balance. So this is one of the accounts that we're learning that does not have a normal balance. The income summary balance is based upon whether we have a net income or a net loss. So when revenue is greater than expenses and we have a net income, the income summary account has a credit balance, which would make sense since sales has a credit balance and capital has a credit balance. That would demonstrate an increase in our capital. When expenses are greater than revenue, if we have a net loss, the income summary account has a debit balance. Again, this would make sense. If we have a net loss, it's going to have a negative impact on our capital. Capital's normal balance is a credit. A net loss would be a debit. Therefore, it would decrease our overall capital count on our balance sheet. So there are 4 closing entries, and we close these in this order. Again, this is something that you need to memorize. There are some things that you have to process and think through. There are other things you just have to know. This is something you just have to know. So there are 4 closing entries in this order for a service business are income statement accounts with a credit balance. So the only account right now that we are familiar with that has an income statement account with a credit balance is sales. We are going to, when we close that entry, if sales has a credit balance, we are going to debit sales and we are going to credit income summary. We will journalize that in the general journal. Our next closing entry is the income statement accounts with debit balances. Again, if an expense is normally a debit, we need to credit that. So when we record it in our general journal, we are going to debit income summary and we are going to credit all of our expense accounts. The third account then we're going to close is the income summary. Now the income summary account is the balance of sales minus expenses. So that's either going to be a net loss or a net income, and you will see all of these numbers right on that worksheet. So when we take a look at that net income or net loss with the income summary, depending on the balance is going to determine if we're going to need to debit or credit it. If it has a net income, then the balance is a credit. So we will need to debit income summary. Now the account that is going to match that is capital, which makes sense, right? If we have a net income, that has a positive impact on our capital. So net income would be a debit. We're going to credit capital, which means when we go to post that in the ledger, that our capital is going to increase. Now let's say that it has a net loss. That means that the income summary balance is going to be a debit. Therefore, we need to credit that. And then that means we would debit capital, which again would make sense because now it's going to decrease the amount of capital when we go and post it to the ledger. And the last account that we are going to close is the owner's drawing account. The normal balance for the drawing account is a debit. If we want to close it, that means we need to credit it for that same amount. If we're going to credit the drawing account, we have to debit something. We are going to debit capital because the drawing account impacts our balance of capital and the value of our business. So when we debit capital and we go to post it, we are going to see a decrease in our capital, which makes sense because when the owner draws money out of the business, this decreases the value of the business. So where do you find all of this information that we need? There's actually a few different places you can look. You can actually find the information in your ledger, your general ledger, because those accounts will be up to date, except for income summary. But probably the easiest place to look is on your worksheet. Your information needed to record the 4 closing entries are found in the income statement and balance sheet columns of the worksheet. And we'll take a look at that in a moment. So there are 4 steps for journalizing a closing entry. Similar to when we journalized our adjusting entries, we are going to write the title, closing entry. Now a closing entry can be located on the same general journal page as our adjusting entries. It will go right underneath that. Remember that adjusting entries begin on a brand new general journal page. Right underneath that then will be the closing entries. Then, of course, we write the date in the date column, we write the title to be debited and the amount, and we write the title account to be credited and amount. This is nothing new. We know how to journalize. We are just learning 4 new transactions that we're going to journalize, and which are the closing entries. Oh dear. If an income statement account sales has a credit balance, as we mentioned, the sales account is debited and the income summary account is credited. And we already talked about why this is so. If an income statement account expense has a debit balance, the income summary account is debited and the expense account is credited, which we've talked about. The journal entry to close the income summary account, if it is a net income, the income summary account is debited because if it is a net income, income summary is going to have a credit balance. In order to close it, we need to debit it, and then we're going to credit owner's capital, which would increase owner's capital. Net income increases the value of our business. Now, if that income summary is a net loss, then it is going to have a debit balance. Therefore, we are going to have to debit owner's capital and we will credit income summary. Again, this makes sense. If we have a net loss, then capital is going to decrease. The value is going to go down. The normal balance for capital is credit. Therefore, by debiting capital, it is going to decrease the overall value. And then our last closing entry, the journal entry to close the drawing account. Again, the drawing account normal balance is a debit. Therefore, we need to credit it to make the account 0. So the owner's capital account is going to be debited, which again makes sense because drawing from the business decreases the value. And the owner's drawing account then is going to be credited. A reminder, after you journalize your closing entries, you have to post to the ledger and update the balances. Again, this is step number 4. Every time you journalize, then you post, all right? So for section 8.1, what you're going to be doing is you're going to take a look at the worksheet. Then using the worksheet, you are going to complete your closing entries, and then you are going to post those closing entries to the general ledger. So let's go ahead and practice. All right, open your workbooks to page 159. We're now actually going to practice our closing entries. You will notice that on page 159, it provides for us the worksheet. In the worksheet, we have the income statement balances, and our balance sheet balances. Now, as a reminder, we talked about that we are only closing temporary accounts. Therefore, all of the items on the balance sheet side, minus the drawing, of course, we will not be closing. So everything from cash to capital is going to remain open and remain with a balance. Everything from drawing and down is going to end up with a zero balance in our general ledger. So let's take a look at what this looks like. First of all, remember, we need to close in order of the 4 closing entries that we discussed. So again, number 19 on your notes. So the first closing entry that we need to close is our income statement accounts with a credit balance. If you take a look at the income statement columns, we currently only have one account with a credit balance, and that is our sales account. Now, you will see again, these are our updated balances. So sales has a balance of $2,160. Now, that means that we need to debit that account. And as we mentioned, we are going to debit that account into our income summary. So let's take a look. So now our next step is income statement accounts with debit balances. So if we take a look at our income statement accounts and we take a look at our debit balances, again, we see that those are right here. Alrighty. And our total expenses then is the $1,483. So it even gives you that information as well. So if these are debit, then we need to credit these amounts, and then we're going to debit income summary. So let's take a look back at the worksheet. You see $1,483 right here. Okay, that is our total expenses, and that is the amount that is back, and take a look at our worksheet. Alrighty. Let's see if I can. Alrighty. If you now take a look, our net income is listed. So here is the net income. It tells you net income, and the net income is $677. Again, income is going to have a credit balance, and therefore we need to debit that. Again, if we take a look back at our worksheet, we see that our Connor Whitney drawing has a $1,700 debit balance. Okay, if it is a debit balance, we need to credit that, and the account that we're going to debit, the account that's paid. Again, you're going to title at the top of your general journal page on page 160, you're going to title that Closing Entries. Then you are going to record the date. Again, it is the end of the month, so we'll record as a 30th. The reason we actually don't have a month in there at this time is because we have adjusting entries above that, which should all happen on the same date in the month. Then we are going to debit $2,160, and we're going to credit income summary for $2,160. In a moment, we'll actually go back and do all of the post-referencing at that time, because we will post to the general ledger, and we'll take a look at what that looks like. Now let's go back and take a look at the worksheet, our general journal. Now, again, this is where it's going to get interesting because we now have multiple accounts. So we have income summary. You notice that we are going to debit it for $1,483, which is the total expense amount that was listed on our worksheet. So when I take into our income summary. Then in order to make those balances zero, whoops, that's attached itself, oh well, you would then notice that we now have listed all of the expenses and the amounts. And again, all of these amounts came from the worksheet. So those are all listed. So take a moment, press pause, and record this information. Our third step is to close the income summary account. So this actually equals net income or net loss account. And if you were to take a look at the income summary here as a credit, and then if you take a look here, that has a debit balance. If you subtract those two numbers, you're going to end up with a credit of the $677. All right, so we need to go ahead and debit income summary for $677, and then we are also going to credit our capital for that same amount. Okay, all right, so at this time, right now, if we were to go and post, and we will do this in a moment, sales is going to equal 0. All of our expense accounts will equal 0. And now our income summary account is going to equal 0. So then our fourth and final closing entry is the owner's drawing account. That is the capital account. So we have Connor Whitney Capital for $1,700. And then Connor Whitney Drawing for $1,700. And that is how you do the closing entries. So now your next step is to post these closing entries to your general ledger. All right, you've done posting before. Again, you go line by line. All right, so we're going to start with sales. If you take a look at sales, again, we need to debit sales for $2,160. So you need to go to and find your sales account, which is located on page 162 in your workbook. Head back, and you are now going to record that as our post reference at 410. Now you're going to do the same with income summary. Income summary, credit $2,160. So I'm going to find my income summary account, also located on page, and then record that again on your post reference. Now you need to do the same thing for all of the following accounts. Income summary, your expenses, then your capital and your capital. Please go ahead and pause while you record that, and then you can take a look to check your answers. When you are completed, sales, because it is a temporary account, should have a 0 balance. All of your expense accounts, because they are a temporary account, should have a 0 balance in your ledger. Your income summary should have a 0 balance in your ledger. Your drawing account should have a 0 balance in your ledger. Your capital account will still have a balance, as that is part of your balance sheet, and therefore it will carry over. All right, so pause, complete, and then check your answers. And then your 62 number. If you take a look on page 161, you will notice that none of these accounts were impacted. The reason none of these were impacted, again, these are permanent accounts. These are accounts that we see on our balance sheet. All of these on page 161 represent an asset. Okay? And you will notice currently sales has a balance of $2,160 credit. Again, if you take a look, we have done a closing entry to debit that for $2,160. And so therefore, it's G8, you debit it for $2,160, and now it has a zero balance because a credit for $2,160 and then a debit for $2,160 equals zero. So you just draw a line to show a debit balance. Then, of course, you're going to take your account number, April 30th, G8, whoops, right there it is, $2,160. Now we've got a credit balance. This is not our closing entry yet. That's why it still has a balance. Okay. All right. Now, and then of course, you're going to take your account. Taking a look on page 162, we have accounts payable, which is our liability. And again, nothing happened with that account. All right. If you take a look at your capital account, though we had changes in the balances, you notice that we still are carrying a balance. The net income increased capital, the drawing decreased capital, but we still have a balance because that is a permanent account and therefore we can carry balances. Now we see the drawing account. That should have a zero balance. Your income summary. It had 3 transactions take place. Your sales, which increased the balance to a credit. Your expenses, which decreased the overall credit balance, which now that equals net income. And then our third closing entry is to close income summary, and therefore now it has a zero balance. Taking a look at sales, sales also has a zero balance as it is a temporary account. Flipping over to page 163, every one of these represents an expense account. And so therefore, every one of these accounts you should now see as a zero balance. If these still have a balance, you need to go back and check your general ledger to see if there's any mistakes. And that is how you complete closing entries.